Hi, everybody. I'm Patty Brennan. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. I can't think of a better introduction to what I'm going to be talking about today in this Ask Patty Brennan series than what do you do or what should I think about if I have a sudden wealth event? You could win the lottery. Your company could go public. You could receive an inheritance that you didn't anticipate. What should I keep in mind? What should I consider? First and foremost, everybody worries about taxes. What are the income tax implications? If it's the lottery, they withhold that, right? But what about inheritances and, other forms? What about that company that just went public? Depends on the kind of stock that you have. Do you have options? Or did your stock come from RSUs, et cetera? So the first thing is, okay, what are the income tax implications? I'm going to talk about that a little bit more. The first question would be, okay, what are you going to do? How does your life change? So let's assume in the first example that you received an inheritance. And that inheritance is comprised of some cash, a portfolio of stocks and bonds, an IRA, and an annuity. First and foremost, you should know that the Secure Act 1 and 2 really has impacted what you have to do as it relates to IRAs and also annuities. I got a call from a friend of mine, received an inheritance 5 years ago. He just left it with the original company and the advisor, and he was taking his distributions as required from the IRAs, but he didn't take anything from the annuities. Well, let me tell you something. Annuities are also subject to these rules, and because he hadn't taken any money out for the 5 years, he's got to cash it all out within year 5 and pay all of that income tax at ordinary income tax rates in the same year. So just understand when you have these times that this sudden wealth event occurs, make sure that you're getting good advice. That's an expensive mistake right there. Also, keep into consideration as you think about the holistic impact on your financial plan. If all of a sudden you've got $3 million, well, if you think about life insurance, as I would define it, life insurance is there to create money where it doesn't exist yet. Your company just came public. You're a millionaire. Do you really need that $1 million policy anymore? Probably not. But I will tell you, you probably need a big fat umbrella liability policy because you got a bullseye on your back. So if anybody gets in a car accident or falls in your home, that umbrella liability will protect what you received in that sudden wealth event. Another thing that you might want to consider, again, talk to an attorney, but consider the titling of the account that you put that money into. In Pennsylvania, for married couples, the default is usually joint with rights of survivorship. Yeah, you know what? That's fine. If it's Ed and I love you, Ed. If I die first, you can have the money. If he dies first, I can have the money. But in Pennsylvania, we could also title it tenancy by the entirety. And in that case, we receive this wonderful inheritance, this wealth event. If it's tenancy by the entirety, we both have to do something wrong in order for that to be attachable. Well, guess what? Only one person can drive a car. And that's usually what people are sued for. So even the titling of your accounts has a major impact on that what you do with that money. From an income tax perspective, very important to understand the implications. And by the way, let's go back to, paying off debts and, the other things that most of us have to pay for. For example, like you think about those of you who may have kids in college. If you have a sudden wealth event, you've got to disclose that on the FAFSA form. You may not get the college aid that you are anticipating. That will also impact what you pay for Medicare and Part B because of something called IRMA. You're going to be chances are, if planning isn't being done, you're going to pay more for health care when you're retired, Medicare and Part B. So that's very important. Chances are you're also probably going to be subject to that 3% investment tax. Again, What are you going to do about it? It's okay. You're still keeping the rest of the money. I don't want to let the tax tail wag the dog. I just want you to be aware of it. Your tax bracket in general is going to go up. Capital gains rate is also in jeopardy. You may not be able to get that 15% capital gain rate. It might end up being 20%. So if you were to sell anything, you've got to take into consideration that you're going to be paying 23.8% instead of 15%. What are you going to do about it? Maybe nothing. You don't want to give the money back, that's for sure. It's just important to recognize that you've got to keep that money set aside to pay the taxes next April. Also important to recognize how you receive that. If you received this money as an inheritance, that's got completely different income tax implications than if it was from a company going public, okay? Completely different. Understand what it means in your tax situation. Ideally, if it's from an inheritance and you got this thing called a step up in cost basis, wouldn't it be wonderful if you received it as an inheritance? Chances are there was a step up in cost basis, so income tax planning isn't as important as it would be if, for example, a company went public. Company goes public, yeah, maybe you don't want to sell it all in 1 year. Maybe you can think strategically and keep your tax bracket, even in the 12% tax bracket, capital gains for joint couples, it's $90,000 before you're paying any capital gains tax on the sale of that stock. In terms of long-term planning, be really careful. You've received this wonderful gift. Rerun your numbers. Yes, it's wonderful, but it doesn't mean that you can stop working necessarily. You've got to think things through. I think a lot of times when something like this happens, people come out of the woodwork and, I don't know what it is. There's a book that was written, I wish I could tell you the author. It's called Sudden Wealth. And there are so many examples of people having a sudden wealth event and then people coming out of the woodwork saying, can I have this? Can I have that? Chances are receiving a lump sum may have an impact on your risk tolerance, your overall objectives, what you want to do for your family, what your estate plan will be. It might be a good opportunity to establish a gifting program over time to be able to get that money out of your taxable estate and help the people that you love most. Are you charitably inclined? You could put a lump sum of money in a donor-advised fund and divvy it out over a number of years and different charities. And that can change. So that's the whole point. This is not a once-and-done type of event. It's something that you want to evaluate on an ongoing basis as part of your planning. Look at the cash flow implications, the tax implications, and be careful about people finding out about it. Scams are rampant in our country today, and people who have had these sudden wealth events, especially when they're publicized, are the biggest victims. So there's lots of things to consider as it relates to a sudden wealth event. The takeaway for those of you who are listening and watching today is get professional advice. Talk to your advisor. Talk to your CPA, your attorney. Get all of these people together and run your numbers so that you're making good decisions that are based on your future reality and the life that you want to live. Thank you so much for joining me today. I'm Patty Brennan. We're Key Financial Wealth Management with wisdom and care. And by the way, for those of you who are listening, I am really hoping that you all have a sudden wealth event. Thanks for joining me today. Take care.